Hey guys, welcome to Sunrise Extra. We are doing a special Q&A today live with Brent Petty, president of Northwest Capital Management. He is the financial guru that was so kind enough to come in early. You're always up early, I guess, because you're watching the market. Right. Good things, at least right now at 7:01. The market is up. Thank you so much for coming. You're answering people's questions. If you guys have questions about your retirement, investing, stuff like that, text them to us. 503-226-5111. We're also always monitoring YouTube, Twitter, and Facebook to see your questions there.
We are basically offering free financial advice this morning, for goodness sake, so get on board.
Take us up on it.
And hit us up with some questions for Brent.
So we saw the Dow go up. Right now I'm looking at my phone, it's up like almost 3%. First of all, comment on what you saw this morning after this big drop yesterday, and then is that the bottom, or is it going to go lower at some point?
Good question. I think today's bounce is a welcome relief in the market after the last couple of days. I think that's predicated on some rumblings that we might get some type of economic stimulus package to help on the payroll tax front. And so I think the market is embracing that. My understanding as I'm reading the headlines is that's still in the works. There's nothing imminent, so a lot of things can get derailed there, but I think the market is taking that as a breath of fresh air. And a little bit more technical behind the scenes, there are people who bet that the market will go down. It's called shorting the market. And when you get some positive news like that, they will have to reverse that trade and actually step in and buy to take their short positions off, and that boosts the market as well. I think there's a little bit of that going on today.
We also have the numbers on the big board behind you there, Brenda. We're keeping an eye on this morning. We'll get to some viewers' questions in a moment, but Rodney Hill had a question, our mutual friend Rod. You may have heard this a moment ago. He was saying, you know, I have a feeling, this is Rodney, I have a feeling that things are going to go up in about 3 months. And I looked at him like, what do you know? So then I looked at you and like, can you tell me, does Rod have any idea what he's talking about here?
Well, I think Rod's onto something is that both here and abroad, especially in China where this started, there's a lot of stimulus in the marketplace trying to prop up the economy. Super low interest rates, which typically means that's kind of jet fuel for stocks, that once we get on the other side of if you will, the peaking of this virus and the outbreak, that should be a good backdrop for stocks to really rally going forward. I think the $10 million question is just how bad and how long will this virus continue to slow down the economy? And I know that can be a little bit theoretical. What does the economy mean? Really what the market is thrashing around right now is trying to figure out what is the earnings going to be for the publicly traded companies and the markets right now. And are they going to be compromised for 1 quarter, 2 quarters, or 3 quarters? And that's the thrashing that's going on.
Well, can we take a peek at one of the questions here? Because I know a lot of our viewers are like desperate over their 401k. They do not like to look at it. I am 3 to 6 years before retirement. Should I be moving my 401k to a more stable fund? What would you say to that person?
It'd be interesting to know exactly where this person is allocated right now, but if you're 100% into stocks and you're that close to retirement, yes, getting probably to a little bit more conservative profile makes sense. 3 to 6 years away from now, you've got a couple of different options if you're over allocated to stocks. You could go in today on a positive today and take a little bit off. That's always a good thing. And I didn't answer your question fully last time is, do I think that the bottom is in the market? I think we're getting closer, but I would be surprised, pleasantly surprised, but I'd be very surprised if the bottom is in.
Hit bottom.
Yeah, I think there's still a little bit more pain to be had before we're totally done. And so maybe today is a day when you might take a little bit off if you've really been in panic mode. That being said, there's also another strategy. If you're looking at your current holdings and you're like, I really don't want to sell my stock positions because they're down already 20%, maybe 17 to 20% with today's bounce. What could I do? What you could do is maybe for another 6 months or so, you could continue to, if you're still working, you could continue to buy into the weakness in the market. But if it persists beyond that, I would take the next couple years and probably change your ratio of what you're putting into stocks. And maybe you do 60, 70, 100% into like a stable value fund or something much more conservative that doesn't have the stock exposure. And the reason you would do that, when you go into retirement, those would be the first assets you'd spend down. So usually a good rule of thumb is to have a couple years worth of money not bouncing around in the stock market so it's not affecting your budget, and then letting the other portion or the remaining portion of your portfolio bounce around and hopefully go up over time.
I find this to be an interesting question because
You're gonna
not
have to
only
explain this question, Brent, to me, and then answer it.
Not only do I not understand the answer, I don't understand the question. Is it a good time to dollar cost average back into mutual funds, or should I pick a few FANG stocks to buy?
That's a great.
Do you want to read the question again, like someone who knows what he's talking about?
So I think as someone asking, should they be panicking right now? And I think that's the emotional response. And I think that, again, some of the best investment opportunities, at least over my career, have come when you're really nervous. Some of the worst is when you're just absolutely sure the market can do nothing but go up and it goes against you. That's just kind of how the market works conversely. But I think that
It's up there in the corner if you still want to take a look at it. Is it a good time to dollar cost? I don't know. What does that mean?
So dollar cost average is what each and every one of us is doing.
Oh, is that right?
in our 401k. Let's say you're putting $200 a paycheck into your 401k. Well, it goes in at that point in time, and if the stock market's up, you buy less. If the stock market's down, your $200 buys more shares. And dollar cost averaging is just taking some of those peaks and valleys out because you're buying more when the stock market's down and less when the stock market's up. So to answer this person's question, I think this is a great time, especially if you don't have retirement right around the corner. Absolutely be dollar cost averaging. I know that there are different investment advisors around town that specialize in individual stocks. Our shop focuses on mutual funds and asset allocation, so we would be advocating to buy into diversified mutual funds so that you don't miss when the market rallies. Now, I'm sure that there will be some individual names that have been beaten down, and if you're fortunate enough to be able to identify that and you're comfortable doing the research, I think some of those names in the FANG stocks are Facebook, Amazon, Alphabet, Google type of approach that have been the high flyers over the years. And I believe Apple was down $20 a share roughly yesterday, and I think it's up around 9 or 10 this morning. So I think there are some really good names that are beaten down. We leave it to the mutual fund managers to decide which stock to be buying on a day-to-day basis. So our shop at least would advocate buy a diversified mutual fund, take advantage of the broad market being beaten down, stay diversified.
Can you just give a little brief as you can in layman's terms as much as you can? Like for a long time recently, it feels like the economy is strong, things are good, unemployment is low, the news was pretty positive, and then all of a sudden it feels like, whoa, what just happened to the economy? Is it strong? Can both things be happening and be true at the same time, or is somebody not telling us the real deal?
Well, I think that it's a little bit of both, is that the economy has been, and it's been for 10 plus years, recovering since the great financial crisis and recession that took place back in 08 and 09. And you got to keep in mind that the economy has been recovering, but Europe and a lot of regions abroad were still working themselves out of a recession. The U.S. has been stronger, but the rest of the world is still a little bit lagging and catching up. And so what has the globe done? They've made monetary supply available to stimulate the economy. So keep in mind, both here and abroad, we've kept interest rates very low. We've done even quantitative easing over the years.
What is quantitative easing?
So it's where the Federal Reserve will
I'm starting to glaze over.
Yeah, and we'll lose our audience. But that's where the Federal Reserve will actually step into the bond market and actually be buying treasuries to keep interest rate low. And what does that translate to you and me? Is that mortgage rates are lower. So we go out and buy homes and we can buy cars and things like that. We've been trying to unwind that. So if we had an IV, if we call the economy a patient, we had an IV in trying to make sure things were right. And we've been trying over the last 10 years to dial back supporting the market and getting it to stand alone on its own 2 feet. And we saw this in 2018. The Federal Reserve was actually trying to reduce this quantitative easing, taking it out of the system a little bit, and also raising interest rates. And the fourth quarter of 2018, I know it feels like 10 years ago, but the market was down 20+% from peak to trough, as folks were concerned that interest rates were rising too fast relative to the true strength of the economy to stand on its own 2 feet. Now, over last year, we saw the market up 30%, and that was because the Federal Reserve pivoted and started to cut interest rates. So we've got this tug-of-war relationship between how strong is the economy, how strong is the stock market, and how much it is dependent on monetary intervention, both here and abroad, with the union central banks.
So we've been talking about interest rates. The Fed cut the interest rate. There may be a payroll tax cut. This question is great and can apply to a lot of us here in the Northwest because we have had such a hot real estate market. Is this a good time to sell land or a house? Is this a good time to refinance?
Well, I would tell you my expertise is in the stock market, and real estate is not my specialty, but I think they're linked in the economy. I think that while rates stay low, we're seeing a boom right now in refinancing. Here in Portland area, I know that there's a supply-demand issue. It's just not enough homes, especially new homes on the marketplace. I think it still is a seller's marketplace. I will say this is, if the coronavirus really slows down our economy, we see an uptick in outbreaks, and then they have to do like China did, at least temporarily. If they have to quarantine, suspend travel, whatnot, and maybe they're doing that in certain regions versus across the entire country. We may, and I think Charles Schwab was out today saying that this may tip us into a recession. This slowdown here, and recessions are inevitable. They're going to come and go, and that may mean that we slow down a little bit for a couple quarters. I wouldn't be surprised if we saw the housing market, dip a little bit. I think here in Portland, because of the supply and demand, we're probably in pretty good shape as long as rates stay low. But if 6 months or a year from now rates were to start to rise again, I think prices would go down. But that's speculation on my part. You
mentioned the C word there in your last answer, coronavirus. Can we ask you again, how much of this roller coaster the last 2 weeks can we pin on that one reason?
I think that's 70% of it. And again, just putting a round number on it.
And then oil prices the rest?
I actually think I'd put it in this order. I'd say coronavirus 70%. I think the next cross current is the election. And I think what's happened, and it's happened over the last couple weeks, is you had a couple weeks ago out of the Nevada primaries, you had Sanders very strong, and the markets reacted to that, especially in the healthcare sector. Then you had Biden's in Super Tuesday rally, and I think last week was a very volatile week. Markets were up very slightly, but through all of that up and down, we were slightly positive for the week. I think what has happened over the weekend is, I think the stock market, and again, this is a lesser degree than the coronavirus, is what is the probability that we have a regime change? And what is the profitability? What is the profitability? Probability. Thank you. Easy.
I'm the word guy. You're the money guy.
Yes, thank you. What's the probability that we actually see the Democrats take over power in the Senate, which would make it easier to go?
Would the stock market like that or not? Trump has been very strong on the economy.
I think the stock market, by and large, is apolitical, but what the stock market doesn't like is uncertainty. And so it ends up thrashing around saying, what does that mean? Does it care about one party or the other? No, it all translates what's going to happen to corporate earnings. And right now, there is a very favorable tax cut in place for corporations. Tax rates are down lower than they have ever been, and that's been boosting stock buybacks by corporations. And there's been talk, at least early on in the primaries, that might be prohibited going forward. And so there's some thrashing going around what will happen with healthcare, what's going to happen with payroll taxes. Will tax rates not only go up for corporations, but will tax rates go up for individuals? And why does that matter to the stock market? Well, if tax rates go up for individuals, you might think, well, consumption will go down. There's less money in your wallet, so you're not going to be buying things, so earnings will go down. So long term, I think the market's fine as it finds the new reality and adjusts to it. Short term, the market is going to thrash around and adjust to a new regime, potentially. And I think that is a cross current that shouldn't be ignored. And it will continue to bounce back and forth as we see the polls and things change going forward.
So just quickly, Shelley Land on my Facebook page is in her 50s. I'm assuming she's asking for herself. Should we worry if we're in our 50s? She must know, will there be enough time to gain it back and then earn some before she needs to retire, in her early 60s or mid 60s?
If we look back to the last pandemics that have happened, the recoveries have usually started 3 to 6 months later. And again, it can take up to a year to 3 years to see that. So if you go back and look at history, I think the odds are in our favor that over that time horizon that stocks come back and have an opportunity to make money on that. There's always the exception to the rule, and something could happen where we would go into like a significant recession, or if we had a revisit of 2008 or 9. A lot of folks and professionals on the street don't see that, seeing that the foundation of the banks and the infrastructure are much more sound than they were back in 07, 08 when we really had things slow down. So I think that that's a reasonably good time period there. There's no absolute certainty, and that's why in the earlier question is, I think you can take advantage of the market being down here, and if for whatever reason this drags on, then redirect where you're saving into more conservative assets and build up a safety net.
There continues to be a rebound. Quick look at the board behind us. The Dow now up over 700 points. I do want to bring up Ken Yankee, who's watching us live on Facebook right now, because he's asked the same question 3 different times, 3 different ways. So we're going to get to your question right here and now. Can you ask the expert, that's you, Brent, what is the percentage of people actually playing the stock market these days, not talking about the people who are basically, as he puts it, forced to save through 401k through their employer?
Yeah, my understanding is that the folks that are day trading and out there speculating, or just individuals, it's a very, very small piece of the overall market. What was really driving the marketplace are quantitative funds that are run by very, very large institutions, and they use very sophisticated logarithms that are buying and selling depending on various variables that are happening in the economy, market, currency, and whatnot.
Are you more cushioned with something like that versus, buying specific stocks?
Well, I think what's happening and driving the volatility is the person who's going in and saying, I'm going to buy Microsoft today, they're not pushing the market around. But the large pensions and the big computers that are buying on behalf of very large organizations, they're buying hundreds of millions of dollars a day, and that can either push up stocks or push them down. Now, the argument could be made is, are these computers adding to the volatility as they're trading on these preset programs? And it's a double-edged sword in our opinion, meaning that instead of having random people emotionally invest that can lead to either euphoria in the market or steep sell-offs, you have a little bit more order. Now, that being said, if you have a set of circumstances where all the logarithms line up and say sell, you get this void and you can have the stock market drop. We've had flash crashes like that in the past, and that's why they put the circuit breakers in that we saw yesterday morning, have the market pause. But that being said, which is pretty ironic, when the markets go down, all these computers are trading on these logarithms, and the variables just change because the market went down 10% or whatever, and they turn around and they're the buyers. And they can step in when emotional people would be panicked and not. So it's a double-edged sword. I think the net of it is probably smooths things out over the long run, but there can be short-term turbulence.
Okay, will you set me straight? Because I'm not saying that this is even totally accurate, but I wonder about this. So you've got all these big players who are making a lot of money, and they're in the same stock market that I am in when I'm buying for retirement, and they're making things go like that sometimes based on the global force. Is that fair? Is that a good way? Can they have their own little stock market? So, so ours is less volatile, but it does seem like there's a lot going on that the average person feels impacted by, and we don't have control over that, but they do. And it feels like a game on their part. It's a business/game, is what it feels like to the little people.
I think it can feel like that. I don't think that those institutions would say we treat this as a game. They're just trying to make money. Sometimes they do a really good job, sometimes they don't. I think, though, and that's why I come back to using diversified mutual funds, is that there are institutions and professionals with lots of money and a lot of insight and research into individual names. Is Google going to go up? Is Amazon going up? Facebook? What's happening with Netflix? Those things are where mutual fund managers and your 401k can help make those decisions for you. I think that those are very challenging things to do as the average retail Joe, to try to go in with your $10,000 and outsmart all that money. Can it be done? Absolutely. If you're willing to put in the research and time, totally can be done. But for the majority of folks, that's overwhelming. So when you are participating in your 401k, you have two options, probably. You can go in and own index funds, which will just track the different indices in the markets, bonds and stocks, and you just kind of take that off the table and you go along for the roller coaster ride. And you take the events like the last couple of weeks and you just take them in stride. Those are noise, those are opportunity to invest, and know that over time the market goes from the lower left-hand corner to the upper right-hand corner, and you just take it in stride and move forward. You can also use mutual fund managers in there who are what we would call active managers, where they're in there actively buying bonds and or stocks for you on your behalf. They're deciding whether they would buy or sell Google
They're
today.
not calling you in the day and asking
That's right.
you to do those decisions. You just put your trust in them.
That's right. Now they're charging you a small fee, which is called an expense ratio, to make those decisions on your behalf, and hopefully that manager over time picks more winners than losers. But I think that that's probably the best way to even the playing field with the institutions is within your 401k, you actually have access to those, one of the, at least, probably many of those big institutions that you'll be pooled together with thousands of accounts across the country to represent your interest instead of you just one-on-one as a retailer.
Choose your risk category of what you want, right?
Exactly.
We've been taking questions from a bunch of different areas. People have been texting in questions. We're watching the Facebook live feed. We can actually take a question from the studio audience this morning if the studio audience member wants to ask a question. Rod, I thought to myself, geez, aren't you going to be a part of this conversation? Then you said you couldn't be. Now here you are.
Well, no, I was told I was not in.
No, that's. Do you have a question?
Always
Well, no,
in.
but something Brent said earlier made me think of. So I have part of my retirement savings is a Roth, and it's something that I put $300 a month into. And then at the end of the year, if I have extra cash and I go up to, I think it's $7,000 I'm allowed or something like that for the year. So by what you said earlier, it made me think, is now a good time to go, instead of putting an extra $1,000 or $2,000 at the end of the year, maybe I should put that extra $1,000 or $2,000 in my Roth right now.
Love that idea.
You love that idea.
So there's, I think that this is a great kind of fork in there. There's several things that you can do. Number one, when the markets are down, what can you do from an investment perspective? Do you want to get more conservative? Do you want to continue to buy in? Do you want to get more aggressive? Those are all investment related. Then there's the financial planning aspect. Okay, the market's down. What can I do to take advantage of the market being down on a planning side of things? Roth are great ideas here. These are things you can do just simply by saying, I'm going to pick a different bucket to put my money into. This can be huge. If the market is down 20%, if you fund a Roth, keep in mind that anything you put into a Roth is after-tax money, but will appreciate inside the Roth, tax without taxes, and then when you pull it out, it's tax-free. So what you buy today, one would hope, is depressed prices 2, 3, 4, 5 years down the road. All of the earnings from whenever the market recovers will be completely tax-free to you. So I think that's a great idea. And I think there was a question up there about doing partial Roth conversions. When you do a Roth conversion, you're taking money out of a pre-tax account, like a traditional 401k or an IRA. And whatever you take out, let's say it's $1,000, will be taxable income to you in that calendar year. So you want to make sure that you're in a reasonably low or modest tax bracket to do that. But by doing a Roth conversion now, with the market being down, you are taking that $1,000, buying depressed stocks, and you're giving it the next 5, 10, 15, 20, maybe 30 years to not only grow, but when you take it out, it'll be tax-free. The money that's in your 401k right now, a certain percentage of that is going to be owed to the federal and state government. You have to pay taxes on it. The Roth will be tax-free. So this is a great time to be looking at those Roth type of tools and take advantage of it.
You will likely take a hit now, but you will save money in the long term.
Yes.
Got it.
That was good stuff. Thank you.
Thank you very much. Appreciate it.
And we learned a lot.
Yeah, we did.
Right?
Yes,
My pleasure.
You guys did too. Thank you so much for watching. We'll see you tomorrow. Bye.